This is your technical update from the LMAX Exchange Research and Analytics Desk for Friday, June 17th, 2016. Euro dollar. So it's back to where we were at the start of the week, with the euro comfortable back into the mid-range. At this point, the key levels to watch above and below come in at 114.16 above and 110.98 below. Given that the market is tracking back closer to some medium-term resistance, and given this latest topside failure at 116.17 by that 2016 high, the risk is tilted to the downside with a break below 110.98 to expose 108.23 further down. But if the market breaks back above 114.16, it'll put an immediate focus back on towards the 2016 peak at 116.17, which guards against more critical resistance up at 117.10. Sterling dollar. So cable continues to be very well supported on dips, with the market trading down to as low as just shy of 140 on Thursday and shy of that 140.05 key low going back to April 6, ahead of this latest impressive rebound back above 142. But ultimately, the broader pressure remains on the downside, and just as dips are very well supported, rallies continue to be well capped. Look for the market to hold below 143.33 on a daily close basis in favor of additional weakness, while a break and close back above 143.33 would take the immediate pressure off the downside and suggest that the market could be poised for additional upside. Dollar yen. So overall, dollar yen remains confined to a broader downtrend, with the market recently taking out some key previous support in the form of that previous 2016 base at 105.55, which opens the door and sets the stage for this next downside extension that could see us trade all the way back down towards the 100 area. At this point, rallies should be very well capped ahead of 108, while ultimately only back above 111.45 would compromise the current downtrend. Euro Swiss. So Euro Swiss had been dropping in recent trade, with the market trading all the way back down towards and below 108, stalling out at 107.78 on Thursday ahead of this latest impressive recovery. Overall, as you can see, the market continues to be very well supported down towards the 108 area, and so this does set the stage for the potential for a more meaningful bounce over the coming sessions back towards the range highs at 111.30 to 112. Aussie dollar. So Aussie is a little bit tracking in no man's land at the moment, but given the latest topside failure by those 2016 highs at 78.35, there is risk for additional weakness over the medium term. Look for the market to continue to be very well capped now, with a lower top sought out somewhere, ideally ahead of 76, potentially by that 75.70, 61.8 fib retracement off of the 2016 high to 71.45 move, ahead of the next downside extension below 71.45 and back towards the 2016 base at 68.27. If we do see a close back above 75.70, it would suggest that the market could be poised for a more significant bullish shift and retest of this 2016 high at 78.35. Dollar CAD. So good signs here of potential for a major base, with the market now putting in a potential higher low now at 126.55 ahead of that 2016 low at 24.61, which will be confirmed on a break back above 31.89, opening the door for the next major upside extension towards the 135 to 140 area. Kiwi dollar. So Kiwi has seen the market stall out after putting in a recent 2016 high at 71.48. At this point, the market has been content on some sideways chop, but a break back below 69.63 would do a good job of taking the pressure off the top side and accelerating decline, suggesting that the market could be poised for deeper setbacks over the coming days. However, if the market does break back above 71.48, this sets the stage for a more significant structural shift in favor of additional upside. SPX 500. So after stalling out above 2100 yet again, as you can see, the market stalled out several times above 2100 since posting those record highs at 2133 back in 2015. The market has traded down to as low as about the 2050 area ahead of this latest minor bounce. But overall, if you look at this broader, longer term chart going back to the 2015 record high, it seems like we could be putting in another top here ahead of what should be the next major downside extension. A break below the 2020 area will, however, be critical in strengthening this outlook and accelerating declines potentially all the way back down towards the 1800 area. Of course, a break back above the recent 2016 high would negate this outlook and expose an immediate retest of the record high from 2015 at 2133. Gold. So despite this latest setback in gold that we saw in Thursday trade, the market has made a significant structural shift following that break above the 2016 and 2015 high. That 2015 high had been at 1307, and this sets the stage for the next major upside extension in this market towards a measured move in the 1400 area. We had been consolidating for several weeks between 1200 and 1300, so that 100-point consolidation or rough $100 consolidation does suggest that we could see a fresh upside extension equal in size towards 1400. With that in mind, any setback should be very well supported, ideally now well ahead of 1200, in favor of that next higher low and fresh upside.